Welcome to Banking and Finance Laws course. This is the first week. First week we are discussing the history and development of financial institutions in India. This is the second session. We are going to discuss social control and nationalization of banks in India in this class. In the previous class, we have discussed about the history of the bank's establishment in India. In this class, we will discuss only social control and nationalization of banks. Now, what is meant by social control on banks? This is essentially an idea of a socialist state kind of ideology, dominated idea, wherein basically it was thought that there must be some kind of social control on the banks so that public welfare can be attained. In a more better way to put it is that banks are doing essentially business with public money, so they should not be making profits with public money. Actually, public money should go for the welfare of the public. This is an idea. So where you say that when public entire Indian people are depositing their money with the banks, it is the right of the Indians and the Indian national policies and the government to ensure that this money is put to the use in such a way that it contributes to the nation building. So this is the idea. Now this idea, to implement this idea, what are the measures that were taken and when did it all start? It all started around late 1960s, in a way 67 like that, 1967 or so, where it said that we need to amend the Banking Regulation Act provisions and also we need to introduce lead bank scheme. These are the two major changes that have come up as part of social control on banks. Now let us understand what is meant by a lead bank scheme. Lead bank scheme essentially is like in the entire India is divided into certain districts, 300 odd districts, around 334 or so. Now in each of these districts, there will be one bank which will be identified as the lead bank. The identification of lead bank will be done on the basis of a bank which has major business in that particular region. Say for example, in one district, Canara Bank is having massive commercial operations. Then Canara Bank will become lead bank of that district. In some other region, suppose State Bank of India has major operations. Then State Bank will become the lead bank there. So whichever is the lead bank of that district, that lead bank is given certain responsibility or an obligation to study the credit needs of that district. What are the credit needs? So each district may not have the same credit needs. Some districts may have employment, education, entrepreneurship as a kind of major activity or something like that. Some districts may have agriculture and agro-based industries may be priority. So the credit needs of each district depends largely on the kind of commercial activity that region is involved in, the kind of literacy and enterprising skills the youth and the people of that district have, and the kind of credit access from the other financial intermediaries that region have. All of this will determine the credit needs of that particular district. Depending on the credit needs, the lead bank has to design a flow in such a way that each bank should give loan to whom. Like say for example, the lead bank will determine what percentage of the entire credit can go to which sector or something like that, or which banker should give more loans to which people or which kind of enterprises or which kind of commercial activity like that. There will be a design that will be given by the lead bank which has to be followed by the other banks in that district. So this is essentially lead bank scheme. It tries to channelize the credit needs and match it with the credit availability. So in a way you are giving priority to those sectors or areas which are in need of credit and which are very much required for boosting the national economy. So that is the purpose of lead bank scheme. And the second amendment, the second change that was brought out as part of social control on banks was certain amendments were made to the Banking Regulation Act. And we have already studied in the previous class the original legislation known as Banking Companies Act 1949 was also renamed at that time only in 1966 as Banking Regulation Act. And essentially, the company business and banking is two different things, and banks have certain other obligations other than business people. They are doing business with public money. They have to be regulated more carefully to ensure depositor protection. All of these are there, and besides that, banks cannot do business like other companies, and they can't have their own people or people who don't have knowledge of finance and all to be managing the banks. So they brought in certain amendments in the Banking Regulation Act to give certain kind of criteria to bring in professional management of banks. So the eligibility of who can be bank managers or who can be directors of banks, and how they can't give loans to their own relatives or their own people who have interest. So all these kind of restrictions started coming into the management of the banks, and Reserve Bank also is having power to appoint some people as the directors or remove the people. So some more professional management of banks is what is the idea behind these amendments. So these two major, one is the lead bank scheme, and the amendments which were brought to the Banking Regulation Act essentially were meant to bring in the much needed change which the banks were to do to contribute to the national economic growth instead of commercial purpose of the banks, instead of just making profits with public money. So this is the idea with which the central government introduced the social control on banks around the period 1966 or 67, like that. Now, after this, the Indian government wanted to nationalize the banks. Now, which are those banks which the Indian government want to nationalize? There were many banks operating across India at that time, but 14 major commercial banks in India which had deposits of more than 50 crore rupees were identified to be nationalized. And how does this process happen? The government essentially will take over that bank's assets, including financial assets, their ownership, their management, and that will get transferred to the government of India. And the government of India will pay compensation to the people who established the bank and who are the owners and managers of that banking business. In accordance with their shareholding, they will take that compensation money. And what legislation allowed the government of India to take over that business is the Banking Companies Acquisition and Transfer of Undertakings Act 1969 is the legislation enacted by the government of India to nationalize these 14 banks. But however, the validity of this legislation was challenged by these banks people in the court, and the case reached the Supreme Court of India, and these are the 14 major banks which were sought to be nationalized in 1969 with that legislation, that is Banking Companies Acquisition and Transfer of Undertakings Act 1969. Allahabad Bank, Bank of India, Canara Bank, Dena Bank, Indian Overseas Bank, Syndicate Bank, Union Bank of India, Bank of Baroda, Bank of Maharashtra, Central Bank of India, Indian Bank, Punjab National Bank, UCO Bank, and United Bank of India. These are the 14 major banks which had more than 50 crore deposits was sought to be nationalized. But the case came to the Supreme Court. The name of the case is R.C. Cooper versus Union of India. This is a 1970 Supreme Court decision, and the case was very highly contested case because the business of 14 banks was taken over by the government. And what are the arguments that they have put forth and what is the argument that the government has put forth is very interesting to study. Now let us first look at what is the argument of those bankers whose banks are being taken away by the government. Now their major argument is that there is a freedom of right to trade and business as a fundamental right in the Indian Constitution under Article 19, which is being violated because the government of India is taking over their business and giving them compensation. So their freedom to trade and to do business is completely gone. So that violated the freedom of trade is what they have contended. Then the second argument was nationalizing only few banks. Not all banks were nationalized. Only 14 major banks only were nationalized. They said it is very arbitrary and it violates fundamental right to equality as promised under Article 14 of the Indian Constitution. Now here there is also an interesting argument which was put forth by these bankers is, now who are the 14 bankers that they have selected? They have selected the bankers who have more than 50 crore deposits. Now, that means these are the bankers who have won the trust of the Indian people, so they have more deposits. So, in a way, they argued that you are penalizing the efficient bankers. So, it is like penalty for being more efficient is what they felt, and they said this is arbitrary and violative of right to equality, and they said the right to remedy their compensation was completely inadequate and illusionary. It has nothing to do, they have not calculated the goodwill and any of that, so the compensation was totally not genuine compensation is what they have got. And the other most important argument they said was, already social control is imposed by the Indian government on the banks. So, what is the need to bring in the nationalization and take over our business and you operate it? Now, once you take over our banks, they may not come up in so much competitive way or in a more efficient way, because they said that public sector efficiency cannot be compared with private sector. This is the arguments of the bankers whose banks were sought to be nationalized. Then there is a counter argument which the government of India is also putting forth, that is public interest. Now they say that these bankers having only business interest are not extending their branches where there is a need for the country, but they are only extending branches where they have business interest. So we are not able to reach to the areas and include financial inclusion, and also we are not extending banking to priority sectors like say self-employment or education or providing micro enterprise loans to weaker sections or anything like that. So this kind of priority sectors are completely getting neglected. Agriculture or allied industries are not getting loans or something like that. The government has put forth that public interest is not being met. And secondly, the government of India they argued that it is well within the legislative competence, so you can't say it violated anything, and equality is only among equals. So all the banks above 50 crore rupee deposits are being nationalized. So there is no selective nationalization here, which violates Article 14, and it is well within the legislative competence is what they have stated. And the government also said that the government acquisition cannot be challenged under Article 19 because economic policies should not be challenged, and government policies are the decisions of the government and they cannot be coming under the violation of Article 19 is what they argued at that time. Right to property also was a fundamental right. Later it became a legal right. That was the scenario at that time. Then the other argument about whether social control is already there, then what is the need to privatize these banks is also one of the argument that came out very vehemently. But the government made up this point that when the government does the job is different from government asking private people to do the job. So imagine private persons asked to do public welfare. Will it be different from government doing public welfare? Generally, it should be different because private people will definitely have some level of profit motive, while the government's only intention will be public welfare. So the government said social control only had government asking private people to do public good, whereas nationalization is government itself coming into the shoes of and doing public good. So in a way, government is stepping up itself for the sake of public good. So it cannot be compared with social control. And very importantly, the question of efficiency and all. The majority of the or most of the bank employees at that time wanted to go public, or in a way they wanted to become government employees rather than being the bankers employees. So they want to come under the public sector entities rather than, so most of the bank employees welcomed this move. So these are the arguments that were very vehemently argued against and argued for the in favor of nationalization and against nationalization. These are the major arguments that have come through. Now, what did the Supreme Court had to say on this? So the Supreme Court declared the Banking Companies Acquisition and Transfer of Undertaking Act 1969 as unconstitutional. So the Supreme Court did not uphold the government decision. Actually, the government declared that this act is unconstitutional, and it said that banks were not allowed to do any business, and hence it violated their freedom of trade and business, which is a fundamental right under Article 19. And fundamental rights abrogation cannot be accepted by the courts, and no law can be enacted which violates the fundamental rights. So the government can economic policies can definitely be reviewed by the courts. So this is what the Supreme Court said, and it also said that compensation cannot be illusionary; it must be adequate. When the government is taking away and acquiring something, it must give the compensation which is adequate and sufficient, but cannot give nominal compensation and rub off its job. So this is what the Supreme Court said. Then, to overcome this decision and to rectify the mistakes, or to rectify the few changes, or in a way what the Supreme Court found fault with the 1969 legislation, after the decision the government enacted a new legislation called the Banking Companies Acquisition and Transfer of Undertakings Act 1970. The same legislation name, but the year is 1970. This is the new law. And what did the new law changes are, and how did it, what we call, how did it take care of the Supreme Court decision, and what changes were introduced? Now, the prohibition of doing business on the then existing banks was removed, and they were given enhanced compensation. So, how is it that if they are having freedom of trade, how can the government take over their business? So, what the new legislation 1970 Act stated was that the government will take over their assets, will take over their management and the business, but they are not prohibited from doing any job, any business. So they can start other new banks, or they can do any other business. So their freedom of trade and business is not banned, and they are allowed to do freedom of trade and business because that is a fundamental right. But the existing business, they were not, they were taken by the government, and the then existing business were allowed to carry the business. That means in the corresponding new banks. So the assets management and business of the banks came to the corresponding new banks, and the then existing bankers and that banks, they were allowed to carry business. You can do your other business, or any other bank you can start, but the existing bank came to the new corresponding bank, that is the new nationalized bank. So this enactment with these changes allowed the government to nationalize the 14 major banks. Now, again in 1980, six major banks with deposits more than 200 crores were nationalized, and they are the Andhra Bank, Corporation Bank, New Bank of India, Oriental Bank of Commerce, Punjab and Sindh Bank, and Vijaya Bank. These are the six banks which are also nationalized in 1980, taking the nationalized banks total to 14 in 1970 and 6 in 1980. That is exactly 10 years later. So total together 20 major banks were nationalized. So this is how they have nationalized the six major banks and with more than 200 crore deposits in 1980 were nationalized, and we can see today nationalized banks have uh, raised more public deposits. They flourished. Of course, today how they are we will see later, but this is how the banks were nationalized after the case, and that happened. But later, what happened with the nationalized banks and government holding in the nationalized banks? Originally, when they were nationalized, they were completely owned by and managed by the government. So, complete ownership, that means 100% share in those banks were owned and operated by the government. But in 1994, Banking Companies Acquisition and Transfer of Undertakings Amendment Act was introduced by the government and enacted in the year 1994, and this amendment allowed the private persons or private people, private parties to acquire the shares up to 49% in these public sector banks. Now, why this happened? You can imagine 1994 is the time. In 1901 and 92, India came up with that liberalization policy, what is popularly called as globalization, liberalization, or privatization, and more specifically also known as New International Economic Order. India entered into that league of globalization. We have opened our markets for the liberal policy with liberal policies, and we embarked upon globalization in a major way. So all this has influenced the business laws in the country, and we had to open our doors for liberalization and privatization. And in that context, Indian nationalized banks holdings, the government has reduced its share up to 51%, and it allowed private people to have a share up to 49%. So in the public sector banks, even today, government holds more than 50% share. So the minimum that government owns on any time will be more than 51%. So what happens when a government owns more than 51%? So any decision making will remain with the government because it will be the major shareholding. So it will influence ownership share, and it will influence management decisions, and also it will influence operations of the banks. So in a way, government still completely has its control over ownership and management and business. In a way, though it is not completely owning the shares, ownership decisions, management decisions, operations decisions in these nationalized banks are completely held even today by the government only, and private people's share is limited to 49%. That is the maximum share any other than the government can hold. So this is how it happened, and nationalization enhanced the public trust in the banks in a very massive way, and this led to the mobilization of huge deposits. And nationalized banks performed much better than other private banks. That argument of the bankers that private sector will be more efficient than public sector proved wrong in this case. Nationalized banks performed far, far better. They could provide credit to the priority sectors in India, hitherto neglected areas, and people who were not receiving credit access. All of them were given, and they allowed the government and they helped the government with planned economic growth. They aligned with the government, their policies, and because it is a government bank only in a way, so they were going hand in hand, and it helped the national economic growth also. And they expanded their branches. Too many branches started, and that led to in a massive financial inclusion in India. So many people could join and could get access to the formal banking financial services. So many changes happened with the nationalization. So with this, we will conclude our discussion on nationalization of banks, and we will discuss different kinds of banks in the next class. Thank you.